Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, June 10th, 2021. We are still mostly higher right now, despite having tested the unchanged line. That is what I would consider a counterintuitive result. The story today, the number that people had been waiting for days, was the CPI release. And no matter how you measure it, it was not good. I don't know how else to put it. The numbers showed higher than expected inflation. CPI rose 0.6%. They were looking, sorry for looking down, but I had to double check that, rose 0.6% versus a 0.5% expectation. The core was higher. Pretty much any number you sliced was higher. So bad inflation, that's not what the Fed wants to hear in theory, and inflation is not necessarily good for stocks or bonds. And so what did we do in the stock market? Of course we rallied, right? Because, I don't know, markets are good at rationalizing. So I think you had some buying that had been put on the sidelines ahead of the CPI number. And I think when the CPI number came out, it was bad but not disastrous. But you can rationalize it by saying, well, A, it's still transitory by the Fed's definition, so they're not going to do anything yet. Or B, that inflation can be good for stocks because stocks can provide a hedge against inflation. That's actually true. It's not always thought of as the case, and I don't know that higher inflation is particularly the best rationale to be buying stocks at the valuation levels that we're seeing. I think that argument works a bit better when you're trading at a more historically conventional valuation level. But nonetheless, the futures started moving up, and I've noticed this pattern over the last few days. The futures just sort of rally into the open, and I think it's really mechanical. I think traders have figured out that this pattern's going on, and if traders have figured out that this pattern's going on, the machines have figured out that this pattern is going on because, again, remember, I know we like to think of the machines as this monolith, but the machines are basically programmed by to pattern seek in many cases. And it's people who program computers. And so basically, if people figure this out, computers figure it out too. And so I think you've gotten into this pattern of the futures seem to rally into the open most days. This morning, I think because that rally sort of caught people by surprise, it was bigger and a bit more furious than we might have expected. And that's why we were up nearly not 1% at the highs, called 0.7, 0.8% at the highs, a little bit more in NASDAQ. At the time I sat down to make this video, we were actually unchanged, but in the time it took to get set up and stuff, we're slightly higher, call it about 0.2% higher. But this is the kind of market we're seeing. Nobody really wants to step away from it too much. I shouldn't say nobody, but people don't seem to want to step away from it too much. The momentum still is there. The trend is still longer term pointing up. Those are not necessarily reasons why you exit a market like this, but there are some worrisome signs, inflation being one of them. The other one that I'm keeping an eye on, and I've written about this before, is the fact that the Fed has been draining liquidity on a record basis via the reverse repo market. And there was a story in the Wall Street Journal about how essentially banks are trying to turn away deposits because they don't know what to do with them. What's going on with the reverse repo facility and is that basically the Fed doesn't want interest rates to go negative. I think the U.S. is not set up for that situation, and the Fed realizes that. The problem is, particularly with all the stimulus that's been floating around from the fiscal side, it hasn't all been put to work, and it's sort of sloshing around the banking system. When the banks have nowhere to go, they use the Fed's reverse repo facility, which is basically a way that the money comes out of the banking system and is absorbed by the Fed. That is technically draining liquidity. Adding liquidity is when funds flow to the banking system from the Fed. They do so typically by buying bonds And so when you buy the bonds, the money goes out of the Fed and into the system. In the case of the reverse repo, the banks are sort of temporarily selling buying the short-term fixed income from the Fed. And so that money is flowing out of the banking system. It's the kind of thing that you see around end of month, end of quarter, typically, certainly end of year. Banks want to get their balance sheets in order. The system gets a little, it can get a little bit difficult for the banks because nobody really wants to put stuff on their balance sheet if they've got it if they've got it organized properly. So the Fed being the buyer or seller of last resort, they do this as a service to the banking system. The fact that we're seeing record numbers, that it started in late May and are going into early June, and who knows what we're going to see going into the end of the quarter, which is still about 3 weeks away. It's going to be very interesting. And I do have to wonder how long the Fed, in the face of inflation that may or may not be transitory, and one can argue some of it is coming from higher wages, and higher wages tend to be sticky, not transitory. We saw companies offering signing bonuses to get people to work for them. Those are transitory. The signing bonus is, by definition, a one-time thing. A salary increase tends to be sticky. And so it's getting tougher and tougher for the Fed to argue that it's transitory. You also have to wonder, does the Fed start to get a little bit nervous or start to question the idea of pumping liquidity into the system on one hand and then draining it right out on the other? Seems kind of like a futile exercise to me. And so these are the things we have to wrestle with. As of now, stocks took the over. They kind of said, all right, well, we kind of had felt a little bit that felt like there was a little bit of a pent-up rally. We've tended to see futures rally into the open. And that's what we saw today, I think, just on a bigger magnitude. They've also tended to fade after the open. We saw that, but I'm taping this relatively early in the market day, so I don't know where we're going to end. Whether the little bounce we saw off of Unchanged holds, or whether it's just that's temporary as well. That's all trading. The trading part that I do think is interesting is sort of this idea that we're going to rally them into the open and sell them to somebody. That's one of those things that works until it doesn't. And as of now, the stock market and the bond market, really, because it really hasn't sold off more than a couple basis points, seem okay with the CPI numbers. So yet again, the numbers that everybody was waiting for that were going to move the market didn't. And here we sit. And so let's see what happens as we get further into the month, toward the end of the second quarter. And here we sit for now. Have a good one, everybody. Bye-bye.